Silver is already near $100. Gold is already staring at $5,000. And everyone is asking the same question. Do you sell, fit, and protect profits now, or buy more? Because the real move hasn't even started yet. But here's the part most people are missing. The biggest buyers are not traders. They are taking delivery quietly, in record size. And when the world finally realizes what's happening behind the scenes, the price won't pull back like people expect. It could jump without warning and leave most people locked out. Because the real risk isn't the dip. It's the day you can't buy at any normal price. And that day might be closer than anyone thinks. So the real question is, when $100 silver and $5,000 gold hit, is that the top, or is that the trap door opening? Welcome to our channel, where we explain big money moves in simple words, especially for wise viewers who've seen many cycles before. If you're someone who remembers how fast prices can change, and you don't want to be late this time, then please subscribe now. Think of it like locking your door before the storm, not after it starts. And one more thing, comment below and tell me, you're watching from which city and which country today? The psychological milestone. What $100 silver and $5,000 gold really signal? When silver approaches $100 an ounce and gold moves toward $5,000, most people instinctively think the same thing. They assume something extreme has happened. They assume prices have gone too far. They assume this must be the end of the move, not the beginning. In financial history, however, major round numbers rarely mark conclusions. Far more often, they mark recognition. They are the moments when a long-ignored reality finally becomes visible to the public. Markets do not move only on supply and demand. They move on belief. They move on psychology. They move on whether institutions, corporations, governments, and long-term capital allocators accept that a new environment has arrived. Numbers like $100 and $5,000 act like alarms. They do not create change. They announce it. For decades, precious metals have existed in a strange financial position. They were officially treated as commodities, yet quietly handled as monetary instruments. They were described as outdated, yet constantly accumulated by central banks. They were dismissed in public, yet used in private, as balance sheet insurance. This contradiction allowed gold and silver to rise slowly without attracting broad attention. That phase now appears to be ending. The approach toward these milestone prices signals that precious metals are crossing from a specialized market into a systemic conversation. Once a price level becomes simple enough for everyone to remember, it stops being a chart number and starts becoming a social signal. At that point, behavior begins to change. Long-term capital does not react the same way retail traders do. Individual investors often ask whether it is time to sell. Institutions ask something very different. They ask what is broken. They ask what assumptions are no longer safe. They ask whether old models still apply. From that perspective, silver near $100 and gold near $5,000 do not suggest excess. They suggest validation. They suggest that something beneath the surface has been tightening long enough that it can no longer stay hidden. In most historical cycles, the public only becomes interested in an asset after a large move. By then, the real positioning has already happened. The visible price surge is not the cause of the shift, it is the evidence of it. This is where the difference between speculative thinking and strategic thinking becomes critical. A trader sees a number, a strategist sees a message. The message is not that silver and gold are high. The message is that the environment that once kept them quiet is losing control. For years, precious metals pricing was treated primarily as a financial phenomenon. Charts, interest rates, inflation reports, and currency movements dominated the discussion. Physical behavior rarely entered public analysis. Yet history shows that when monetary systems begin to destabilize, physical flows eventually overpower financial narratives. The first signs of that shift rarely appear on price charts. They appear in quiet places: vaults, shipping manifests, delivery notices, and industrial procurement contracts. By the time milestone prices are reached, those quiet shifts have usually been underway for years. One of the central ideas emerging from current metals analysis is that gold and silver have not experienced true price discovery in the modern financial era. Their prices have largely been set inside paper markets, where leverage, derivatives, and cash settlement dominate behavior. In such systems, volume does not equal ownership. Most contracts never result in metal changing hands. They only change financial exposure. As long as that structure holds, prices can be influenced without metal moving. But once demand begins migrating from financial exposure to physical control, the structure itself becomes stressed. At that point, price is no longer driven mainly by opinion. It is driven by availability. Milestone prices often emerge when that transition becomes impossible to ignore. A useful historical pattern repeats across asset classes. Early in a repricing cycle, specialists accumulate quietly. Later, institutions validate. Only after that does the public notice. The public then interprets visibility as lateness. In reality, visibility is simply the end of the silent phase. From that lens, the question, should someone sell at $100 silver or $5,000 gold, may already be misframed. It treats price as the core variable. The deeper variable is structural alignment. Has the global system finished adjusting, or has it only begun? Major capital rarely positions based on upside alone. It positions based on risk. When sovereign funds, central banks, and large institutions change behavior, it is usually because existing systems no longer feel reliable. Metals then shift from investments into strategic reserves. At that stage, selling is no longer about taking profit. It becomes about reducing insurance. The difference matters. Insurance is not held because it rises. It is held because something else may fail. This is why milestone prices historically accompany rising institutional interest rather than declining participation. They mark the moment when holding metal becomes socially acceptable again. They remove the stigma of fringe positioning. They allow large allocators to justify what they were already doing quietly. The deeper question underneath these numbers is not whether silver and gold have gone far. It is whether the systems surrounding them are becoming less stable. That instability is not measured only in inflation. It appears in debt saturation, currency weaponization, supply chain restructuring, and rising geopolitical fragmentation. Each of these increases the strategic value of neutral physical settlement assets. When multiple long-term pressures converge, price often becomes the last signal, not the first. Seen in that context, $100 silver and $5,000 gold do not represent excitement. They represent acknowledgement. They tell decision makers that metals are no longer behaving like ordinary commodities. They are behaving like balance sheet instruments again. And once that shift occurs, the question is no longer whether a number has been reached. The question becomes whether the old environment that kept prices contained still exists at all. Because if it does not, then these milestones may not be ceilings. They may be thresholds. The focus moves away from price entirely and toward the behavior that often precedes every major repricing event in financial history: physical delivery. The real signal: why physical delivery matters more than price. Most people watch the precious metals market the same way they watch stocks. They look at charts. They track headlines. They follow daily price moves. They assume that price tells the full story. In reality, price often tells the smallest part of it. Behind every quoted price sits a complex structure of contracts, exchanges, warehouses, clearing members, and settlement systems. In modern metals markets, most activity happens inside paper systems. Futures, options, swaps, and unallocated accounts dominate trading. These instruments allow exposure to silver and gold without ever touching metal. They are efficient, liquid, and highly leveraged. They are also mostly financial promises. In such systems, enormous volume can exist without significant physical movement. Millions of ounces can trade in a day while almost nothing leaves a vault. As long as participants are content to settle in cash or roll contracts forward, the system remains stable. Price can move sharply without metal being demanded. But when behavior changes, the entire structure changes with it. One of the most important shifts any metals market can experience is the transition from trading contracts to demanding delivery. That transition rarely happens loudly. It begins quietly, with steady increases in the number of contracts that do not close out, but instead stand for physical settlement. Delivery is different from speculation. It is slower. It requires capital. It involves logistics, vaulting, insurance, and custody. It is rarely chosen by traders looking for short-term price exposure. It is chosen by entities that want possession. For that reason, delivery behavior has always offered deeper insight into long-term conviction than price action alone. Historically, when delivery volumes rise steadily, it indicates that the most informed participants no longer view metal as merely a trading vehicle. They are shifting it onto balance sheets. This is not the behavior of momentum chasers. It is the behavior of risk managers. In normal conditions, major futures exchanges function primarily as price discovery and hedging platforms. Producers hedge, consumers hedge, financial traders provide liquidity. Only a small percentage of contracts typically result in physical settlement. The balance changes when trust in financial settlement weakens. When participants begin to prefer metal over cash, it suggests that the contract itself is no longer viewed as the asset. The metal is. This distinction becomes critical. A futures price is an agreement. A delivery is a transfer. Agreements depend on systems. Transfers depend on inventory. In recent periods, delivery activity in precious metals has not only increased, it has accelerated. Large volumes have been removed from exchange warehouses even in months that traditionally see little physical movement. This pattern is important because it bypasses seasonal trading behavior and speaks instead to strategic accumulation. Such behavior typically appears when large institutions or state-linked entities reposition reserves. These actors are not seeking short-term returns. They are restructuring exposure. They treat metal not as a trade, but as infrastructure. Another characteristic of delivery-driven markets is silence. Institutions that acquire physical supply rarely announce it. They move through clearing members, intermediaries, and authorized participants. They spread demand across time. Their goal is not visibility, their goal is access. Because of this, physical stress rarely makes headlines. It appears instead in subtle changes: longer settlement times, rising lease rates, widening spreads, and increasing competition for nearby supply. These signals do not attract the general public because they do not fit into simple narratives. They require familiarity with how physical markets actually operate. Most investors are taught to analyze charts. Very few are taught to analyze settlement behavior. Yet, throughout financial history, major repricing events were preceded by physical tightness long before price reflected it. Currency crises, commodity shortages, monetary realignments. In each case, delivery stress appeared first, public recognition followed later. This is why milestone prices should always be studied alongside physical data. Price shows perception. Delivery shows intention. When delivery remains low, even rising prices can be driven by speculation. When delivery expands, especially over sustained periods, it indicates that the metal is being removed from the system rather than circulated within it. Removal changes everything. An exchange can support enormous trading volume as long as inventory circulates. It becomes constrained when inventory exits. Once enough metal leaves, the system must begin rationing supply. That rationing does not always take the form of visible shortages. It can appear as higher lease rates, delayed fulfillment, substitution of paper claims, or incentives to settle financially instead of physically. These mechanisms buy time. They do not create metal. As physical availability tightens, price becomes increasingly sensitive. Moves grow sharper, corrections become harder to engineer. Margins and volatility controls lose effectiveness when the underlying demand is not leveraged speculation, but outright acquisition. This is why delivery-driven markets behave differently from paper-driven ones. They are less responsive to narratives. They are less influenced by sentiment swings. They are guided by necessity. The participants demanding metal are not attempting to profit from short-term price moves. They are seeking insulation from systemic exposure. That motive does not disappear because of pullbacks. It strengthens during them. For that reason, physical accumulation often accelerates during corrections rather than retreats. This pattern confuses observers who rely only on charts. They expect fear to drive selling. Instead, they see dips being absorbed. They interpret this as resilience without understanding its cause. The cause is not optimism. It is procurement. When metals are being procured rather than traded, price loses its usual role as the dominant signal. It becomes secondary to access. From that perspective, milestone prices are not interesting because of their level. They are interesting because of the behavior that accompanies them. Rising delivery volumes at such levels suggest that higher prices are not discouraging participation. They are legitimizing it. That is a very different dynamic from speculative blow-offs, where volume explodes and then collapses as participants exit. In delivery-driven environments, volume persists because the underlying objective is not to exit, it is to obtain. This difference reframes the central question of this documentary. The real issue is not whether silver or gold are too high. The issue is whether the most informed participants are still trying to get them. As long as physical metal continues leaving exchange systems in size, price should be interpreted not as excess, but as pressure. Pressure that has not yet resolved. Attention shifts to how this pressure is expressing itself globally, and why price differences between East and West reveal more about metal scarcity than any chart ever could. The global divide, how East-West flows are exposing a broken pricing model. When a market is healthy and unified, price differences do not last. Arbitrage closes gaps. Metal moves, capital flows, premiums compress. Over time, a single global price emerges. When a market is strained, those mechanisms begin to fail. In recent years, precious metals have quietly entered that second condition. Instead of a single global silver price, multiple realities have begun to form. In Western financial centers, silver and gold are still largely priced through futures exchanges, derivative books, and leveraged trading systems. In Eastern markets, pricing increasingly reflects physical urgency, industrial demand, and state-linked procurement. This divergence matters. It reveals that the metal is no longer being valued primarily as a financial instrument. It is being valued as a strategic resource. One of the clearest signals of this shift has been the repeated appearance of sustained premiums in Asian markets relative to Western spot prices. In normal times, such premiums disappear quickly. Traders exploit them. Metal moves. The price gap collapses. But when premiums persist, it suggests something deeper. It suggests that the metal is worth more where it is needed than where it is priced. This is not a theoretical imbalance. It expresses itself physically. Metal purchased through Western contracts is increasingly being delivered, transported through Asian logistics hubs, and absorbed into Eastern exchanges and industrial networks. This flow drains Western vault systems while replenishing Eastern inventories. Each shipment reduces the buffer that supports paper trading. Arbitrage in this environment no longer stabilizes price. It transfers supply. Every ounce that moves east to capture a premium does not return. It becomes part of strategic stockpiles, manufacturing chains, and sovereign reserves. It exits circulation. This is the crucial distinction. In financial markets, capital circulates. In physical markets, under strategic demand, inventory migrates. Migration eventually reshapes pricing power. Western exchanges were built for a world in which metals functioned primarily as hedging vehicles. Eastern demand increasingly treats them as inputs and reserves. These roles are not compatible over the long term. One emphasizes liquidity, the other emphasizes possession. As this divergence grows, the tools traditionally used to manage metal markets lose effectiveness. Margin increases, for example, are designed to control leveraged speculation. They raise the cost of holding paper positions. In past cycles, such measures frequently cooled rallies. They forced liquidation. They restored balance. But margin policy has little influence over entities that are not using leverage. Sovereign funds, large institutions, and industrial actors standing for delivery are not sensitive to margin requirements. They are not operating on borrowed capital. They are converting financial assets into physical ones. For these participants, price volatility is secondary. Access is primary. This is why repeated efforts to temper metals markets through financial mechanisms have produced diminishing results. They act on behavior that is no longer dominant. When the primary source of demand is procurement rather than speculation, traditional volatility controls function like brakes on a vehicle that is no longer powered by the wheels they touch. The emergence of backwardation in certain metal contracts reinforces this interpretation. In a normal commodity market, future prices are higher than spot prices. Storage, financing, and risk premiums are built in. When spot prices exceed futures, it signals that immediate supply is valued more than promised delivery. Backwardation is not a chart pattern. It is a message. It indicates that holders of metal require compensation to part with it today. It reflects urgency. Rising lease rates tell a similar story. They show that those who control physical inventory are demanding higher payment to lend it into the market. This behavior rarely appears in markets with abundant supply. It appears when control itself has become valuable. Taken together, these signals describe a market in which metal is no longer plentiful enough to support unrestricted paper expansion. In such conditions, price does not rise because enthusiasm is increasing. It rises because inventory is becoming contested. The consequences of this shift are profound. Once a commodity becomes strategic, it stops behaving like a commodity. It begins to resemble infrastructure. Infrastructure is not sold because price is attractive. It is accumulated because absence is unacceptable. Nations do not measure infrastructure in quarterly performance. They measure it in years of security. This mindset is visible across multiple resource markets, but it holds particular significance for precious metals because they operate at the intersection of industry and monetary trust. Silver is embedded in modern technology. Gold remains embedded in sovereign reserves. Together, they bridge production and finance. As global trade networks fragment and national priorities reassert, that bridge becomes more valuable. The flow of metal from west to east reflects this reality. It shows that those closest to manufacturing and long-term planning are repositioning. They are securing inputs. They are diversifying reserves. They are reducing dependence on financial promises. This behavior is not coordinated publicly. It does not need to be. It emerges naturally when incentives change. What makes the present period unusual is not that arbitrage exists. Arbitrage always exists. What is unusual is that arbitrage is no longer equalizing markets. It is draining them. Each successful arbitrage transaction confirms the same condition. Physical silver and gold are worth more in use and custody than in contract form. Over time, such conditions force repricing, not because traders demand it, because systems require it. Once the flow of metal begins overwhelming the buffers that support paper markets, pricing must adjust to ration demand. The price must rise enough to slow acquisition, substitute materials, or redirect capital. Until that happens, pressure continues to build invisibly. This is why east-west differentials deserve more attention than daily headlines. They are not anomalies, they are early fault lines. They show where metal is being pulled, not where it is being quoted. The analysis widens to place these developments inside the larger transformation underway in global economics, where resources, not narratives, are once again shaping power and survival. The strategic repricing era, metals, mercantilism, and capital survival. Every long economic era is defined by what it rewards. For much of the modern period, financialization was rewarded. Capital flowed into debt instruments, equity markets, and complex derivatives. Growth was measured through valuation expansion rather than production. Prosperity was built more on asset inflation than on industrial depth. That environment shaped both policy and behavior. Nations prioritized financial services. Corporations optimized supply chains for cost efficiency rather than resilience. Investors were trained to view real assets as secondary to paper returns. That era is now under visible strain. Rising debt saturation, persistent trade imbalances, geopolitical fragmentation, and the weaponization of currencies have begun altering national priorities. The world is slowly pivoting away from a purely financial model and back toward one that values control of resources, manufacturing capability, and strategic reserves. This pivot is often described as a return to mercantilism. In mercantilist systems, national strength is measured less by financial reach and more by material capacity. Governments seek secure access to energy, metals, food, and industrial inputs. Trade becomes less about efficiency and more about security. Resilience replaces optimization. Precious metals fit directly into this framework. Gold historically functioned as the foundation of settlement systems. Silver historically functioned as both currency and industrial input. Together, they occupy a unique position. They are simultaneously monetary anchors and production materials. As global structures shift, that dual role becomes increasingly important. When currencies are trusted, metals are relegated to the background. When trust erodes, metals move forward. They provide neutrality, they settle without counterparty risk. They anchor systems that paper promises cannot stabilize alone. This is why gold and silver reappear during periods of monetary transition. They are not chosen by ideology, they are chosen by necessity. Modern debt-based systems depend on confidence. They expand through credit, rollover, and refinancing. They function as long as obligations can be extended forward without disruption. When that process becomes politically, socially, or economically unstable, attention shifts from growth to preservation. Preservation demands assets that do not depend on performance or permission. In this environment, metals begin transitioning from investment assets into strategic instruments. Central banks increase reserves. Nations explore bilateral trade settlement. Corporations reassess supply vulnerabilities. Defense and technology sectors reassess material security. These shifts are not dramatic, they are procedural. They are built into procurement guidelines, reserve frameworks, and long-term planning documents. Yet their cumulative effect is powerful. They steadily redirect flows of capital away from abstract yield and toward tangible control. This redirection changes how markets clear. In a purely financialized system, price is set where leverage meets sentiment. In a strategically oriented system, price is set where access meets necessity. Those are different clearing mechanisms. Necessity does not recede because a chart becomes extended. It does not exit because volatility rises. It adjusts only when supply becomes adequate or alternatives become viable. For silver, alternatives are limited. It remains deeply embedded in electrification, medical technology, advanced manufacturing, and defense applications. For gold, alternatives are structural rather than functional. It substitutes trust, not material utility. As long as geopolitical and monetary tensions persist, the strategic motive to hold neutral settlement assets and secure industrial inputs remains intact. This is the larger framework within which milestone prices must be interpreted. They are not merely reflections of investor interest. They are surface expressions of a deeper reallocation of capital and priorities. In past eras, financial dominance allowed Western markets to define pricing almost unilaterally. That dominance rested on reserve currency privilege, institutional reach, and global liquidity dependence. Today, that structure is evolving. Alternative trade corridors are developing, local currency settlement is expanding, strategic stockpiling is increasing. Nations that once accepted financial claims are increasingly requesting material guarantees. These changes do not dismantle the existing system overnight. They erode it gradually. Gold and silver do not lead these transitions. They record them. Their rising prominence reflects the cumulative effect of decisions made across trade, defense, industry, and finance. They are not drivers. They are measures. From this perspective, $100 silver and $5,000 gold are not extraordinary. They are transitional. They suggest that the old valuation regime, built around abundant leverage and unquestioned liquidity, is yielding to one built around constrained supply and contested settlement. In such periods, traditional portfolio logic often fails. Correlations shift, safe assets change, risk is redefined. Decision makers are forced to move from return maximization to exposure management. Exposure management prioritizes durability over performance. It values what remains functional under stress rather than what excels in stability. Physical metals occupy that category. They do not optimize yield, they optimize continuity. For business leaders, entrepreneurs, and capital stewards, this reframing is critical. The central question becomes less about what will perform best in the next quarter and more about what will remain dependable across structural shifts. As global systems rebalance, those who recognize transitions early are rarely rewarded with comfort. They are rewarded with positioning. Positioning does not seek applause. It seeks alignment. Alignment between assets and the environment that governs them. The environment now emerging emphasizes sovereignty, resilience, and strategic capacity. Within it, precious metals naturally gain relevance. They are not solutions, they are signals. They indicate that the world is placing renewed value on what settles without trust and functions without permission. When markets begin elevating such assets, they are communicating something fundamental. They are not celebrating prosperity, they are preparing for change. And when markets prepare, price follows, not as a cause, but as a consequence.